Thanks for clicking. Canada's fixed mortgage rates have remained relatively stable over the past few months, with bond yields remaining largely unchanged since the Bank of Canada raised rates by 75 basis points earlier on this month. In fact, mortgage rates have remained largely unchanged over the past 3 months, despite the Bank of Canada raising interest rates by 175 basis points since July.
What'd you say?
Fair enough. The cost of borrowing for holders of variable rate mortgages has risen dramatically and is set to do so even more going forward. This has led to a major upsurge in borrowers asking if it's the best time to lock in their mortgage. So what I want to do today is go over the best fixed rate mortgage rates, look at how they compare with variable rates, take a look as to whether or not it's the best time to lock in your mortgage rate, and then discuss what to look for next. Speaking of next, with the end of the month upon us, just 1 week away, we are eagerly awaiting the release of Canada's real estate data for the month of September, which should start trickling in from the local real estate boards in just over a week. We'll obviously have an update out on that data on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into these mortgage rates. So first up, the best 5-year insured mortgage rate. If you'll remember, an insured mortgage rate is where you have less than 20% down, you have a 25-year amortization, you qualify at the contract rate plus 2% or 5.25%, whichever is higher, and you pay for the mortgage insurance. The best 5-year fixed mortgage rate in July was 4.64%, which shrunk down to 4.44% in August, and as of September is 4.49%. And the best 5-year insured variable rate mortgage is prime minus 1.05%, or 4.4%. So with the Bank of Canada raising interest rates, but mortgage rates remaining relatively unchanged, we can see the 5-year insured fixed rate and the variable rate are basically the same, only a 0.09% spread between the two. And the spread between the insurable rates is relatively small as well. Insurable mortgage rates, if you'll remember, that is where you have 20% down, you qualify at 5.25 or the contract rate plus 2%, and you have a 25-year amortization, but you don't pay the mortgage insurance. The best 5-year insurable mortgage rate, if you'll remember, in July was 4.99, which went down to 4.79 in August, and as of September is still at 4.79. And the best variable mortgage rate is prime minus 0.5 or 4.95%. So the best 5-year fixed insurable rate has went unchanged since this point in time last month, leading to a minute spread between the two rates. And we also see this with the best uninsurable mortgage rate. Uninsurable mortgage rates, that's where you take money out of your home vis-a-vis a refinance, or you qualify and you have a 30-year amortization. In July, the best 5-year uninsurable mortgage rate was 5.24, and then in August it was 5.24, and then in September it is now 5.24, with the best variable rate mortgage being prime minus 0.4, or 5.05%. A 0.19% spread between fixed rate and variable rate mortgages. So, in summary, the majority of the fixed rates available, the insured rate, the insurable rate, the uninsurable rate, have all remained relatively unchanged. Contrast that with variable rate mortgages, which at one point in time represented a major discount between fixed rate mortgages, are now relatively similar to the amount paid when you have a fixed rate. So, given that fixed rate mortgages and variable rate mortgages are now basically the same, and with variable rate mortgages set to increase in the cost of borrowing very soon, many are asking, is it the best time to lock in their mortgage? While discussions of the central banks and how high they plan on going on interest rates, especially in light of rising inflation, are definitely important, I want to revisit the work of Moshe Milevsky, which we've talked about on this channel on another video, who quantifiably demonstrated that variable rates in the long run, and I stress long run, outperform that of fixed rates. This work has been oft quoted by many advisors.
Trust me, bro.
And has also been called the most misconstrued paper on mortgage rates that we've ever seen. Without getting into the details that we've gone over in other videos, in Milevsky's work, he called fixed rate mortgages expensive insurance. By insurance, Milevsky means insuring against future increases in the prime rate. Insuring against future increases in the cost of keeping your home. So, say you lock in right now at 4.49%, and then in 2 years, the Bank of Canada reduces interest rates down to 4%. That 0.49, that 0.5% difference that you are paying for your fixed rate mortgage compared with that of variable, that's your cost of insurance. That's your cost of ensuring that if rates did rise, if the Bank of Canada would have gone the other way, that you won't have an increase in the cost of your home. You don't have to worry about having to sell your home if rates go too high. And as with any insurance policy, the greater the risk, the greater the value of the insurance. If a 100 basis point rate hike is going to put you over the edge where it's going to force you to sell your home, then it very well might be worth locking into a fixed rate. So the question as to whether or not you should lock in your mortgage rate is all based on your personal budget. If you can handle 100, 200, 300 basis points more in interest rate hikes,
never gonna happen,
over the next 2 or 3 years, then you might be able to stick with the variable rate mortgage, as it might be worth it to you to take the risk that you'll get the upside if rates go down. However, if those rate hikes are going to push your budget over that edge where you will be forced to sell your home because the payments are just too much, then it might be worth buying that insurance policy that is the fixed rate mortgage in order to ensure that doesn't happen. In order to 100%, nothing's 100%, but in order to 99% ensure the stability and the continuation of the ownership of your home. So in summary, fixed rate mortgages, relatively unchanged over the past few months. Variable rate mortgages up 175 basis points over the past 3 months, to the point where they now cost just about as much as a fixed rate mortgage. Whether or not it's best to lock in your mortgage to go with a fixed rate mortgage right now is all based off of your personal budget. Is it worth it for you to buy that insurance policy? Do you have the budget that can handle the swings, that can handle the increase in interest rates? Very few would have predicted 1 year ago that we would be sitting right now with a prime rate of 5.45%.
What'd you say?
Especially considering that in just June of last year, variable rate mortgages hit an all-time high. And yet here we are, and we just saw from Fed Chairman Powell that the Fed is planning on continuing interest rate hikes for the foreseeable future. Nobody knows for sure what is going to happen in the future. Nobody knows how high interest rates are going to go. What you do know is your personal budget and how high you can handle. There are mortgage calculators out there available there where you can see what the payments will look like if rates do rise by 75, 100, 150, 200 basis points. So you can go through and look how high your payments will be if these rates continue to go up. With that said, how high interest rates go, we'll obviously have an update out on those rates on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.